Hi, I'm Jenny Brown. Welcome to our weekly buy-to-let market update. I hope you're all keeping super well this week. The sun's out today, it's looking really nice, and I don't know about you, but I'm really looking forward to a long weekend at Easter. It feels like things are certainly starting to open up for us. I've already got dry slope skiing and tennis booked for Easter weekend, so that's something to look forward to at last. Also on the subject of things to look forward to, what we're going to cover off today, we're going to be talking about the lender changes in the market. There are some fairly interesting criteria changes that I just want to run through with you, and also some new pricing announcements from lenders. Then we're going to be talking about the housing market and sharing some data with you to give you an idea about what's been going on over the last 12 months. Okay, so lenders this week, there's been lots of activity, both in terms of pricing, interestingly, the vanilla space, which is the lenders who are more of the kind of clearing banks, so those lenders that really don't want to lend to landlords with larger portfolios. And when I say larger, I mean 10 properties or more. And they're looking to lend to individuals, not companies, on very straightforward properties. So we've actually seen some repricing in that end of the market this week, which is good to see. We've also seen some more pricing changes in the specialist end of the market, which has been a real theme over the last few weeks. So great to see the more vanilla lenders coming out to play in terms of their pricing revisions. We've also seen some criteria changes that I just want to share with you as well. So look, first of all, keeping on the vanilla end of the market, what we've seen in terms of repricing. So first of all, the mortgage works have released a 5-year fixed rate product, which is very good. It's a 50% loan to value. And with their product ranges, their rates start from 1.69% on 5-year fixed money. In terms of how the mortgage works sit in terms of pricing, they're very, very competitive. They tend to come at the moment at the top of or very close to the top of the pricing structure. So really great news there. Now, in terms of the mortgage works and really, who they are and who they are good for. So I think for those of you who have been on the buy-to-let scene for as long as I have, you will kind of remember the Mortgage Works back from their very early days. They were originally Sunbank. They then rebranded as the Mortgage Works. They've changed ownership. Most recently, they were acquired by the Nationwide. Obviously, we've also seen various things happen beyond the Mortgage Works control. For example, we've had a credit crisis. So essentially what happened was, back in the day, 15 years ago, when I started at Mortgages for Business, the Mortgage Works, or Sunbank as they were then, were a very, very, very landlord-friendly lender. I think it's fair to say that over time their lending proposition and their appetite has really constricted. So they've really they stopped doing limited company lending would be the prime example of that. But there's been lots of other kind of criteria changes where they've really kind of reined things back in. And I think that's largely because they are owned by such a large high street institution. But more recently, we have seen them start to kind of open things back up again. So an example would be that they went back into the limited company space, which was fantastic. Now, they are a really good lender. We really enjoy dealing with them. Their process is incredibly slick. It's very automated. There's a lot of kind of computer-based decisioning with them, so that keeps things really, really efficient. But what that means is that there is no greyness. So either you fit with their criteria or you don't. But look, who are they looking to lend to? So they have two product sets. They have products available for those landlords with up to 10 properties, and they have a larger portfolio product offering for those landlords with more than 10 properties, both of which are really, really competitively priced. There's no minimum income requirement to take a mortgage with the Mortgage Works, which is really good. And one of the things that I've really liked actually, which really came around with their being acquired by Nationwide, is their approach to slightly unusual property types. The Nationwide essentially made the decision that the Mortgage Works would take on their view on unusual property types. And by that, what I mean is things like eco homes, timber frame. They've definitely got a higher appetite for kind of ex-local authority than they used to. So they've really kind of moved on with that, which is fantastic. Now, the other thing about the Mortgage Works, which is really nice, is that you are able to obtain a mortgage term of up to 35 years, even if you are age 70 on application. Now, you can be not a day older than 70 on application, but assuming that you are 70 or below, you can always have a 35-year term, so essentially lending to your 105th birthday. Now, we've also seen TSB reduce their rates by up to 20 basis points. TSB are a good, solid lender. They have a nice offering. Their rates are competitively priced. They want you to earn £25,000 a year to have a mortgage with them. That cannot be from rental income. The TSB are another lender who's been on quite an interesting journey. They were originally part of the Lloyds Banking Group and then split out from there. So they've adopted a large amount of criteria, which I think for those of you who are BM Solutions familiar, you would recognise quite a large chunk of the TSB policy within that. So one of the things that I really like about TSB is they're very good on studio flats and also ex-local authority. With them, it's a case of we don't have any kind of defined criteria. It really is just down to valuers' comments. Now, with TSB, you can be up to age 70, at the time of application, or age 75 at the time of application if you have a pension. I struggle to think of many people who at the age of 75 wouldn't have a pension. I'm guessing what they don't mean is state pension. I'm guessing what they mean there is private pension. Now, we've also seen, keeping with our vanilla lenders once more, Virgin Money reduced their 80% loan to value fixed rate product. They only have one, and they brought it down. So it's now at 3.59%. It's good enough actually in the 80% market, which is actually quite a narrow market right now. It's quite a reasonably priced product. I think what holds people back on this product and getting to 80% loan to value is the rental calculation. So Virgin are sticking to the standard 145% coverage at 5.5%, rather than adopting the pay rate calculation, which really helps things along. But look, for those properties which are high yielding, this can work really nicely. It's a good enough rate, like I say. To have a mortgage with the Virgin, you need to have no more than 10 background buy-to-let properties. You need to be earning £25,000 a year, which cannot be from property, and you can apply for a mortgage at any point up to your 78th birthday. Now, as you'll see from what I'm saying, there is a real theme in terms of these guys and their kind of appetite and the types of borrowers they're looking for. So with that in mind, we move on now to the more specialist lenders and what we've seen from those guys in the last week. So first of all, Foundation Home Loans have released two new products. One which is a 2-year fixed rate at 75% loan to value, and the other is an HMO product. They're both really good actually. Are they market leading? No, but they're very, very good. And you know what? Foundation has some really nice USPs, which actually means that these products may be very, very competitive if you need to use Foundation Home Loans. So first of all, it's just worth saying that these products are available for a maximum loan size of £1 million. They have no maximum number of properties in the background, although you can only have £3 million worth of borrowing with Foundation Home Loans. Having said that, they will go higher than that, but you need to get it agreed by credit committee. So, you know, if you're up to your limit with Foundation Home Loans and you want more, don't worry, give us a call and we can have that conversation with them on your behalf. Now, Foundation Home Loans can lend to limited companies, SPVs only, please. There's no minimum income requirement, and they are able to do layered companies, so limited company owned 100% by another limited company owned by people. And the other thing that I really like about Foundation Home Loans, which is becoming less and less available in the market at the moment, is they're only taking their personal guarantees from the directors. They're not looking at shareholders. Now that works particularly well for people who have companies where, for example, they have children set up as part shareholders in the business, or alternately they have other family members or business partners who are kind of involved in the business in terms of they have investment financial in it, but they're not involved in the day-to-day running of the business, and therefore offering a personal guarantee is really not appropriate for those guys. LendInvest have also released a suite of new products with pricing starting from 3.29% for loans up to £1.5 million. Now again, LendInvest, they're quite a new kid on the block. They're very, very good. Their process is very, very slick, and there's a large amount of automation. So by that, for example, what I mean is that they can use open banking as part of their underwriting, which really helps speed things along. Now, LendInvest are good for limited companies and individuals. Again, no maximum properties in the background, and they have a no minimum income requirement policy unless you're taking one of their 80% loan to value products, in which case they're going to want you to earn £40,000 per year. So that's the pricing change. As you can see, lots of movement from the lenders, both in the vanilla end of the market and also the more specialist end. In terms of criteria, we've seen some tweaking on criteria changes from a few lenders this week. So first of all, the Leeds Building Society have changed their rental calculation for their applications. So previously they just had one single blanket rental calculation, sort of a one-size-fits-all approach to rental calculations, which they've clearly found is a barrier to people doing business and borrowing money from them. So what they've done is they've brought in a tiered rental calculation now, which is based on your tax code. So it's worth saying here that the Leeds Building Society are only lending to individuals. There's no different rental calculation if you are a limited company. So look, if you're a basic rate taxpayer, they're now stressing at 125%. If you're a higher rate taxpayer, it's 145%. And if you are an additional rate taxpayer, it's 150%, which is largely in line with lots of other buy-to-let lenders at the moment. Now, we've also seen TML, the mortgage lender, change their criteria. What they've done is they firstly increased their minimum loan amount from £25,000 to £75,000. Now, you may remember that we've also seen Precise Mortgages in the last couple of weeks increase their minimum loan size, and also Vida Home Loans. So what's happening here is essentially there are definitely less lenders in the buy-to-let space, particularly in the limited company space, where lenders will take on those smaller loan amounts, which means smaller property values. So first of all, we saw Vida Home Loans increase their minimum property value. Then we saw Precise move, and now obviously what TML have done is think, oh my God, we're actually just getting so many applications in where the property values are low. If you imagine if their minimum loan amount is £75,000 and they're looking at 75% loan to value products, by virtue of that fact, their minimum property value becomes £100,000. But what they've obviously been doing is looking at what's coming across their books, realise that they're getting far too many applications on those lower property values. So they've had to push their loan amount up to kind of really try and redress the balance there. Now, what they've also done is said that they're not going to be accepting first-time landlords any longer, and that's until further notice. What's their logic behind that? To be honest with you, I simply don't know. I guess maybe they're getting too many applications in from first-time landlords and they're uncomfortable their book is leaning that too far that way, so they're just looking to change things. Now, also, we've had some news in from Paragon. Now, we do lots and lots of lending with Paragon because they are a really good lender. They're very, very good in terms of their pricing in the limited company space, but also they're fantastic for HMOs and multi-units, particularly larger properties. So you'll recall that I've mentioned previously that they can do HMOs and multi-units on buy-to-let rates of up to 20 units or 20 letting rooms, which is really, really good. So they're a very, very strong player. So what they've done is, first of all, that they have gone back to instructing valuations on submission of the or on receipt of the application coming in. So that's what they always used to do. Then during COVID, what they've done is push the valuation instruction point back further into the application. What they've clearly realised is that actually this is really delaying things in terms of underwriting time. So they've brought that back in again to the instructing valuations on receipt of the application. That is really actually very valuable for those people who are looking to buy properties and have got a large amount of pressure coming on them from estate agents. So what you will often find is that estate agents, until they actually see a valuation being instructed, they won't take properties off the market. So this will really help kind of cement your acquisition, secure your property purchase. The other thing is as well is that actually some people are quite unsure about how to value their own properties at the moment. Obviously, on one hand, we've got property prices holding firm and going up. On the other hand, there's kind of lots of doom and gloom press being reporting going on at the moment. I think it's fair to say that a lot of people are saying, well, if I'm doing a remortgage, how much do I actually say my property's worth? It's really hard to say. So actually getting a valuation done early on in the application, if the valuation figure coming in at a certain level is really key for you, is actually really vital, because what it means is that you find out if that's going to be a deal breaker essentially for you very early on the application process and can save you lots of time. Now, the other thing that Paragon have done is brought back in their forward funding facility, which we love. Now, their forward funding facility is essentially where they, first of all, the key point to mention here is you have to have an application with them already. But when they're underwriting that application, what they will then do is look at the borrower, probably have a telephone interview with you, discuss your kind of situation, your ambitions for your portfolio and what that's going to mean in terms of funding requirements going forwards. And then what they do is give you a pre-agreed credit facility. Now, the benefit of that is, first of all, that it means that when you then need to call on that facility because you're buying a new property going forward with Paragon, it really, really, really speeds up the underwriting time. So it really expedites your offers and makes you a very efficient buyer. The other thing is that it does save you future money, because what Paragon do is charge a £299 application fee every time they receive an application from their borrowers. By having this forward funding facility agreed, they don't ask for that £299 fee, so it also stands to save you some money. So this is really, really popular for those borrowers who have it. They really, really rate it. So as always, lots of changes in the lender space this week. I do sometimes wonder when we do these videos if I'm going to have anything to talk to you about, but the changes just keep on coming, and thankfully at the moment they are all positive changes. So I've got two bits of other news to share with you this week. The first one I just found really interesting, which is that UK Finance has shared data from last year, particularly in the context of mortgage payment deferrals and that kind of stuff. So I just wanted to share them with you because I just think they're really interesting. So what they're saying is that in 2020, 2.75 million mortgage payment holidays were granted. I hate using the word holidays because they weren't, but anyway, their words, not mine. So 2.75 million mortgage payment holidays were granted up to the end of 2020. At its peak in June 2020, there were 1.8 million mortgage payment holidays in place. There were 1.18 million credit card payment deferrals. 828,000 personal loan payment holidays were issued, and at the start of this month 82,000 was still in place. So I think really it just goes to show the absolute magnitude of what happened, and also the support that was made available to borrowers over the last 12 months. I think in terms of how the market is now reacting with the lenders to people who took mortgage payment deferrals, because these are largely now becoming quite historic, most people stopped really using them in autumn of last year. There's a good window between the mortgage payment holiday and now showing people, you know, making their payments on time. So actually we don't see this coming up and becoming an issue like we did at the back end of last year. But I think it's fair to say that if you are someone who is still taking a mortgage payment holiday, just know that the lenders are going to ask a lot more questions around your finances, potentially won't even lend to you till you're out of the mortgage payment holiday. But actually, you know, like I say, you know, this is really quite historic stuff now, and actually we're not finding that it's coming up in conversation or causing us problems for clients in any way like it did at the back end of last year. And lastly, in terms of our news articles this week, just in case you weren't convinced that the housing market has been super busy, some proof from you, this time from HMRC. So what they have reported is that UK residential transactions totalled 147,050 in February 2021, which is 48.5% higher than in February 2020 and 23% higher than January 2021. Now, what we saw that February this year showed the highest number of residential transactions in 14 years. They went on to say that on a non-seasonally adjusted basis, transactions totalled 122,840, 48.3% higher than February 2020 and 26.4% higher than January 2021. So yeah, you know, look, that just really reinforces everything that we've been hearing. There are absolutely loads of purchase transactions going on at the moment. The news on the word on the street is that things are not slowing down. The housing market is still incredibly busy. The average turnaround time that properties stay on the market at the moment is the shortest that they've been in a really long time. So things are moving quickly. So if you are thinking about buying something, I think it's fair to say that right now, if you're after a good property, you're going to need to be pretty quick on your toes. That's everything for this week. Thank you as always for joining us. We do appreciate you taking the time to come and have a watch or listen, depending on how you access this, and hearing what we have to say. We'll be back again next week as usual, but until then, if you do have any questions, please do give us a call 0345 345 6788, or go on our website mortgagesforbusiness.co.uk. We have one more week, Mortgages for Business at home, until we're sent back to the office. At the moment anyway, that's the plan. The first week back in the office, I'm actually on holiday, so I'm going to be reporting to you, hopefully, fingers crossed, from a barn in Wales, which should be interesting. Goodness only knows what the Wi-Fi is going to be like. So until next week, look after yourselves, and I'll catch you next time.